Today's webinar with the title ESG Investing, What Did 2020 Tell Us So Far? So this webinar is brought to you by the ESG and Responsible Investment Committee of CFA VBA, the Netherlands. I'm Som Tui, Equity Officer at Oiko Credit, and I'm a member of that committee. And I'll be a moderator today, helped by Irma Willemsen and Helene de Vlaam. We've got two great presenters today. Firstly, Nina Roth, Director of Responsible Investment at BMO Global Asset Management. And she will be followed by Hortense Bioy, Director of Sustainability Research for EMEA and APAC at Morningstar. After both of the presentations, we'll have 15 minutes of Q&A. And at the webinar, we'll have a few minutes of wrap up. So before we begin, I wanted to cover some housekeeping items. Firstly, this webinar will be recorded, so your participation in it is presuming you're okay with that. We'll see how to make it available to you afterwards, either through a link or through the CFA VBA website. Secondly, regarding the Q&A, so you'll be on mute for most of the session, but during the Q&A, you can ask a question in a couple of ways. So the first way and preferred way would be to, if you go to participants in the right of your screen, and if you click on the little hand icon next to your name, that will be raising your hand. And when you're called for your turn, you can unmute yourself, please. And then we would also request that you put your video on when asking the question, but obviously up to you if you want to do that. Please make sure that you're on mute again after you've asked your question, unless you have a further comment. There's a second way to ask a question, and that is just simply using the chat and typing in there. We'll do our best to keep an eye on that. But the preferred way would be to raise your hand and use your video, make it a little bit more personal. So with that being said, I'm very much looking forward to both presentations today. So I think we can begin with Nina's presentation on ESG and COVID-19. Thank you all for your attention. And Nina, please take it away.
Oh, sorry. Wrong one.
Super, but I can start with an intro. Thank you very much for having me. I'm Nina Roth. I am part of BMO Global Asset Management's Responsible Investment team. Just briefly, we are an investment manager with around 370 billion Canadian dollars asset under management. We have a long history in responsible investment. We also offer engagement and voting services for third parties. And we are one of the founding signatories of the Principles for Responsible Investment. I personally am, as I mentioned, part of the 20-head strong responsible investment team. I cover, as an analyst, financial institutions and social topics across the industry, across industries, and you will probably see that or hear that in the presentation as well. With that, we can move on to the next slide, please. Just to set the scene, I'll be speaking from the perspective of responsible investment, mainly from an active ownership point of view. I will try to show you which implications we are seeing for individual components of E, S, and G, and I will be briefly touching upon recovery considerations at the end. First, looking back at the last half year, it's fair to say, and pretty obvious, that COVID-19 had profound implications for ESG and the whole responsible investment world. We'll hear more in the second presentation on that as well. But of course, from an engagement and corporate analysis perspective, it included short-term crisis management issues around staff management, around stakeholders. There were practical issues to address, such as how do you hold an AGM if you're not allowed to meet in person? And we are definitely expecting long-term implications across a range of ESG issues, including climate change, obviously. A clear focus was, and that was also indicated in the invitation to this webinar, was on the social. So once the world has realized which industries are truly systemically relevant, like healthcare, food production, food retailing, it became evident that various social issues like health and safety protections, fair pay, sick leave have been widely ignored and definitely needed improvements. So still, and I'll be going into detail shortly. Despite the immediate crisis, the broader ESG issues cannot be abandoned, and we need to still look at E and G issues at the same time. We have seen a massive increase of collaborations among investors, and it's really remarkable. Probably one of the reasons why that was because it was easy to connect and coordinate and communicate with everyone at home, and also obviously because there was a huge urgency of certain issues that needed to be solved and addressed, and where investors had or could play a role. And just an example, it's more from the anecdote side. BMO Global Asset Management has signed more investor statements in support of certain matters in Q2 than in all of 2019. So, and a lot of them were focusing on social issues. I'll walk you through the E, S, and G implications now, and we can move on to the next slide. Starting with E on environment. So clearly, given that full industries had to fully or close to completely stopped operating for some weeks or even months, there was a definite fall in greenhouse gas emissions. Clearer skies, you've probably seen the satellite images around Southeast Asia, and particularly China, and how the factory emissions, well, were non-existent anymore given lockdowns. There was one estimate that EU emissions could drop by 1 quarter, while at the same time there was chatter, and that's actually something that needs to be investigated further, that despite these very drastic involuntary halts to emissions, various national climate targets would still not to be met. So from a climate change perspective, you wonder how on earth can we then manage a transition to a low carbon economy if such drastic halts do not have a lasting major impact. At the same time, and in addition to that, from a political perspective, important global summits and negotiations were halted. So the international climate agreements around COP26, which was considered the biggest and most important COP after Paris, but also like biodiversity negotiations for COP15 were all postponed to next year, and thus certain regulations or agreements could not be furthered. So longer term political and economic implications are still emerging. From a corporate perspective, the major developments include, well, first of all, and that's like very evident, the fall in the oil price, which at first undermined, of course, the investment case for higher cost oil projects, larger oil projects. And after some months, we've even seen like oil giants, BP, and also Shell announce multi-billion write-offs, and Exxon fell out of the Dow Jones index. So that's all obviously like negative for these corporations, could be turned into something positive, and also a positive investment case. So, and that's a very recent example from today, where BP announced that they would move into renewable energy and cooperated or formed a strategic partnership with a wind offshore company. It's named Equinor. But at the same time, we need to closely monitor credit portfolios of large institutional banks and their exposure to the oil and gas industry. We've seen and have analyzed that some quite large chunks of non-investment grade loans are held in these industries, and this might have consequences further down the line. Significant short-term headwinds were experienced for renewable energy projects, mainly related to supply chain interruptions, and they couldn't go ahead as planned and had experienced major delays. And then further considerations could be added in terms of the permanent behavioral change and the question whether how permanent it is. In terms of transport, we've seen in many cities across the globe a shift to more bicycle transport, but also on the other hand, more private car transport, both out of the consideration of health concerns. Moving on to the next slide, and with that also to the social. What you can see here are BMO Global Asset Management's 2020 engagement projects. And this is one way how we prioritize engagement over the year, which also includes consultations with clients. And for 2020, you could clearly see a majority of the projects were linked to climate change, environmental stewardship, biodiversity. And COVID-19 has changed this course a bit, where we do continue to engage on all these themes. Each engagement now features also a discussion around a company's COVID-19 response. How do they ensure business continuity? How do they protect their workers, etc.? And I go a bit more into detail on the next slide. So how that actually looked in practice. We've been asking in our engagement with companies for definitely greater attention, how they treat staff and stakeholders more broadly. For the engagement asks, we particularly ask for the provision of protective gear, like a question of life and death in certain areas, which was particularly difficult in the first few weeks as production couldn't follow the demand globally. And in the US, we could see that the availability for a personal protective gear or equipment for all of the staff was only achieved by the end of April. So you can think from a European perspective, 6 weeks into like the worst of the crisis, into the worst of the pandemic, and people still need to go to work and couldn't protect themselves or weren't protected by their employers. And obviously, from an engagement perspective, investors need to play a role and push companies to protect their workers. At the same time, we ask for the provision of paid sick leave, quite common in Europe, not so much in other parts of the world. We also ask, and that really across the world, for more flexibility for employees, specifically for those with childcare or other caring responsibilities, and also an adjustment of performance targets and expectations towards these employees, or all employees probably, in addition to emergency financial and mental health support. We've seen a huge step up in mental health support from various industries, very positively. Briefly touching upon supply chain issues on the social side, here our advocating continues. It's still, well, when we speak with companies, we are still asking that they pay their suppliers early, that they do not extend payment lead types, that they support local communities on the ground, and looking at some positive examples, and I come to them in a second, also supporting their supply chain companies with loan or grants. And what we're currently doing is that we are engaging, excuse me, that we are engaging companies to lobby regional governments to stick to existing labor laws. So that mainly affects the garment supply chain in northern India, where the regional governments have stated that they would suspend labor laws for 3 years, which it makes it very difficult for companies to act and predict regional conditions. If we move on to some best practices, that's on the next slide. There were also some positive examples, which do not always continue until today. A lot of the retail chains, and Kroger, one of them in the US, upped their hazard and bonus pay. But in the example of Kroger's, that was only for the first few months, and they're back to normal now. And we continue to engage them to pay living wage salaries. Positively, we also see other retailers that have committed to permanently hire the staff that they had onboarded during the crisis. For example, in the UK, Tesco's has made 16,000 employees permanent, and others continue, also in the US, continue to pay premiums or lump sum bonuses, which obviously helps in an overall situation of economic constraint. Unilever, very positive example, has committed $500 million cash flow support for its smaller suppliers. From our perspective, that's clearly also learning from the financial crisis to keep supply chains alive and to recover more easily once everything is back to normal, whatever that normal looks like. Last in the trifecta, G for governance. Moving on to the next slide. I'm starting with the operational angle. So COVID-19 has hit a few weeks just before the absolute height of the proxy voting season. So very, very quickly, hundreds of AGMs either needed to switch to virtual or being postponed to later dates. In North America, we've seen mostly move to virtual, where in Europe, there was often a mixture of or a hybrid version of virtual and in very small in-person meetings. The virtual AGMs came with challenges around full participation, engagement, exchange with senior management wasn't as easily possible as it is an in-person meeting. You also had limited ability to ask a question or also to follow up on the question. So with the ad hoc switch to virtual, it was a bit more challenging to hold AGMs as they should be held. And postponement delayed certain decisions on dividends, but also on capital raising authorities. We've also seen various regulators that have requested banks to cancel dividends or to not undertake share buybacks, which in that situation was definitely supported. Our thematic engagement focus was twofold. One, on pay, so make executive pay decisions consistent with the treatment of wider staff. That's something we in general engage on, but in this particular situation, it became even more visible. So that you don't have huge pay and bonus packages on the executive side, while large parts of the employees on the other side are furloughed or even laid off. We have also seen substantial number of companies implementing voluntary executive pay cuts, which was probably the quote unquote only sensible thing to do in that moment. The second aspect or focus of engagement was around the management of redundancies, and this is something that we will see now more and more in the next few weeks and months, asking companies to work on reskilling their staff, on considering redeployment, including their employees in decision-taking, so enhancing engagement and consultation, to not, in their layoffs, disproportionately impact already disadvantaged groups from staff, and also support. And now, after ESG, looking ahead, how do we recover from all that? And with that, moving to the next and last slide. I've put the SDGs on this slide. If we move to the next one, super, thank you. To show that there is, we have this global commitment in place to achieve the SDGs. But it's also to show you how significantly our challenges have increased in that matter. So think about SDG 1, no poverty. We now know that due to COVID-19, over 70 million more people are expected to fall into extreme poverty. We know, like SDG 4, quality education, with month or half years, and in certain regions of the world, even longer schools permanently closed, or the switch to virtual or digital education not working properly, the education gap will increase even further. SDG 5, gender equality, with the continuation of care responsibilities still dominantly executed by women on one hand, and then women disproportionately negatively affected on employment opportunities. There is a pushback on gender equality for decades, or the gains that we've seen in the last few years are pushed back for decades. Obviously, all for achieving the SDGs in a certain time frame. This makes it even harder than before. And these were just the social issues. Environmental ones are there as well. But still, the recovery discussions that we are seeing mainly focus on environmental issues. And that's not to say that they shouldn't. It's just that they also should include social aspects more broadly. So we see the EU that has the green and digital recovery package lined up. We have ongoing discussions in the US and in the UK on Green New Deals. And we've seen some bailouts linked particularly to sustainability aspects, but that were very individual cases. So just an example, Air France, the French airline, as part of their bailout package, they were asked to drastically cut their emissions and basically minimizing in-country or eliminating in-country flights indefinitely to achieve that. So looking at the challenges at hand, clearly for a sustainable recovery, we need a broad collaboration. Much faster action is needed than before. We've been speaking about climate change at the beginning, and that the emissions involuntarily cut, are not sufficient to reach the targets already agreed. We need definitely faster action on the social issues as highlighted before. And we can't focus on one of these issues, but we need to focus on all of them. And here I stop and open up for questions.
Great. Do we have any hands up? I'm not sure if I can see them, but Irma Helene, can you see any hands up?
Not yet, Son.
And I think someone has just sent a message. Nina, will COVID be, thank you very much for the really interesting presentation. Do you think that COVID will be abused by some companies? So will they postpone ESG measures and blame it on COVID? So you talked a little bit about what they're doing, but perhaps some are stopping doing some ESG measures.
Yeah, very good point. I mean, we've seen some companies highlighting that they don't have, or they have limited capacity, they have more urgent needs, they have some emergencies that they need to cover firsthand, which is understood to a certain extent, but probably after now half a year and slowly moving back into at least for a while, I hope, into a new normal, the expectations will fully go back on, and investors will need to and will push for not further delaying these. And we've also seen that there were some calls for delaying regulatory implementations from a sustainability perspective. And some consultations were slightly delayed, but only for a couple of months. So probably we can wait a couple of months, but we cannot wait much longer. In terms of, we've experienced that with some conversations that we had. On one hand, it was easier to get through to senior management, to get board members to speak to us. But on the other hand, also some operational experts and also some investor relations officers were not able to respond just because they were furloughed. And so this is obviously something where, yeah, that needs to be monitored and seen how this evolves.
Great, and I think we've got a question in the chat. Do you think COVID-19 will be an opportunity for companies to strengthen the governance and management may consider more ESG issues? So I think what they're trying to say is, do you think that governance will be strengthened through COVID?
Yeah, I mean, if we look how the financial markets have positively perceived ESG aligned products or sustainability products, and we will learn about that in a moment more. It's clear that the overall performance of companies that are aligned with ESG issues or have a good sustainability risk and opportunities management in place, they will perform better in the mid to long term. And an example like Unilever that has basically learned from the financial crisis and former crisis and from the social and governance angle and implementing it now, it will make it easier for them to succeed in the future. And so clearly, I think it is an opportunity, but it's also like a must.
Great. There's a few more questions coming in. EMEA, is there anything on the anyone with their hands up who wants to ask with the video a question, or will we continue like this?
No one dares to show their face.
No, not yet. But there's a few questions. There's a few questions coming in. So I think you've already talked about some initiatives in the market. So, for example, statement to take by the Dutch government to take sustainability as a cornerstone. To make sustainability the cornerstone of COVID-19 recovery plans. Do you think that the initiatives will work? Someone's asking. That's a big if, isn't it?
Yeah, I mean it's a big if, and well, I know, like, for discussions around COP26, it is, for example, clear that we don't yet know how much money we actually need to address the whole issue of, let's say, climate change. I mean, that's very broad, but how much money do we actually need? And so if we then turn this back to the national government discussions and how much money they are assigning for the recovery or committing to or pledging, it's probably just a number they're taking out of the air, and they probably can make available. But it's not clear whether that fully addresses the challenges at hand. But as mentioned before, it just has to work.
Understood. Yeah, very big numbers being around. That's for. So there is another question which has come in, which is, will COVID be the big breakthrough for ESG, or will it be forgotten once we have a vaccine and everything is back to normal?
I mean, I partly answered that with, like, the earlier question, that I think from a pure financial markets and investment perspective, it was so obvious that ESG funds or sustainability funds have outperformed their, and also active management has outperformed passive management, and so it's very obvious that sustainability has to play a role and will play a role going forward, because it probably, if it can weather a storm like COVID-19, it can also weather smaller storms and proves to be a better investment without giving any investment advice.
Great. Yeah. And I think, do you see, you mentioned social and social initiatives from companies. Do you think that investors, do you foresee any major changes in the weighting of social going forward? So there is attention being paid to it now. Do you think that will continue or not?
Yes and no. Well, yes, as in we have to, and also, as I mean, we see from an EU level and various national developments also in the Netherlands, where mandatory human rights due diligence on a corporate level, but also on a product level needs to happen. And for that, we need data, and this data is not available. So on one hand, yes, the intention will rise, and the regulatory pressure will rise, but we also need to implement it, actually, and there are certain challenges to it. But to answer the question, I think it will remain in high attention, but we will also, looking at the engagement, we will also need to really focus on some of the issues, because I highlighted a couple of cases, specifically in the retail sector, where we see companies are already scaling back their very good commitments from the start, and it's now a half year in, so and the pandemic is still on fire. So yeah, it's early, and more action is needed.
Yeah, great. It's a very interesting space. So I think that we're I think the time is up for Q&A, unless there's someone who's got their hand up who wants to get a last one in. But otherwise, I think that's no. So then I think, well, thank you very much for the presentation.
Oh, Sam, I'm sorry.
Yeah.
I see a question here from Jeroen Schippers. He raised his hand.
Great. Please go ahead.
Hi, Nina. Jeroen Schippers here, Rhymes Technologies. I was wondering, as an angle, because of COVID, have you changed your approach to responsible investment as a whole, or does it predominantly work as a tangible example when speaking to investors and with the importance of the various factors?
I mean, as a firm, we are, quote unquote, just further and further and more in-depth integrating ESG in all our investment processes. So it also receives more attention in our own company. And yeah, it is widely integrated in the investment analysis. And we are further developing the system, getting more data, joining more initiatives, and stronger working with companies to implement it. Hope this answers your question.
Yeah, super. Thank you.
Great. Then I think we're out of time for this session. So thank you very much for your presentation, Nina, and also thank you, Jeroen, for your question, and also others who have posted their questions as well. So I think that now we'll turn to Hortense's presentation, looking at the latest ESG trends in the current environment.
Hi. Thank you, Sam. And good afternoon, everyone. It's a pleasure for me to speak to you today. I have prepared a few slides that you will start seeing on the screen very, very soon. Yeah, just now. So these slides will show how well sustainable funds have done so far this year, despite the COVID-19 pandemic, and how well they've done in terms of flows, assets, but also in terms of product launches. I will also talk about other trends that we're seeing in the ESG investing world. So next slide, please. So I'll start with an overview of the ESG fund landscape by domicile. I'm sure it doesn't come as a surprise to anyone that Europe largely dominates the global ESG fund landscape with more than 80% of the assets and 3/4 of the products. I think there's an echo in my, I don't know if you can hear it, some. I think
yes,
someone
there is a bit of an echo. Could everyone make sure that they're on mute, because that might be interfering. I think we can try again.
I think it's the CFA Society V BA Netherlands that is not on mute.
Elaine, could you put yourself on mute, please?
Thank you. Great. Thank you very much. So yeah, I was just saying that Europe obviously dominates the ESG fund landscape. At the end of June, we really reached globally a milestone, because global assets surpassed the $1 trillion for the first time on record. So at this point, I know some of you are going to wonder how we define ESG funds. So this is what you can see on the right-hand side. You see there a definition and scope for our ESG fund universe. So these are open-end and ETFs that by prospectus said that they use explicit ESG criteria as a key part of the security selection and product construction process. These are funds also that, some of them indicate that they pursue sustainability-related theme and or they seek measurable positive impact alongside financial return. And we have excluded from our universe funds that employ only limited exclusionary screens, and also those funds that say they do ESG integration. So these are funds that consider ESG factors, but these are factors that are not binding when it comes to security selection or portfolio construction. And we've also excluded from our universe money market funds, feeder funds, and fund of funds. So just to be clear about how we define the universe, and in Europe, as you can see now, there are 2,703 funds. That's at the end of June. Next slide. So far this year, flows into ESG funds globally have shown resilience. On the left-hand side, you see global flows. On the right, European flows. In Q2, flows into European sustainable open-end funds and ETFs reached a record high of over 54 billion euros, and this is double the inflows that we saw in Q1 when there was the whole COVID-19 sell-off. We still saw positive flow in Q1 for sustainable funds, whereas we saw massive outflows in the overall European fund universe. So that shows the resilience of those funds. And I think this inflows that we saw in Q1 and now record inflows in Q2 can be explained really by two main factors. The growing interest in environmental, social, and governance issues from both institutional and retail investors, especially in the wake of COVID-19 crisis. The disruption caused by the pandemic has highlighted the importance of building sustainable and resilient business models based on multi-stakeholder considerations, as Nina mentioned earlier. And another contributing factor to the strong inflows was the continued growth of the sustainable fund universe in terms of number of products. Next slide. So we saw there again in Q2 that product development stood very strong in both in Q1 and in Q2 globally. But obviously, again, here in Europe, this is where we saw the strongest growth in terms of number of new products, with over 200 new funds with an ESG flavor, including 50 passive products in the first half of this year. And this brings the total of European sustainable fund to 2,703. And I've looked at also the activity so far in Q3, and we're still there also. We're still also going to see very similar levels of new products in Q3. So next slide, please. Now, in addition to these new funds being launched, we also continue to see more funds being repurposed and rebranded. So these are funds you see on the graph in green. They come on top of the newly launched funds that I just talked about, which are represented in blue. And repurposed funds are funds that were not ESG when they launched, but they became ESG because they changed their mandates. So they've added very specific ESG criteria to their investment objectives or policies. And in many cases, they've also changed names to reflect their new mandates. So this is a very, very interesting trend, I think, very important trend as well, especially in Europe, that now we've been tracking for a year. And we say that asset managers are greening mainstream funds. So how are they doing it? Well, they reduce exposure to companies with the highest carbon footprint. They reduce exposure to companies with the worst ESG scores, the most controversial stocks. Some are completely divesting from fossil fuel. Some also have completely converted to a best-in-class strategy, or something that is very close to best-in-class. Or they also they have converted into like a new sustainable thematic strategy. So a climate strategy, for example, we've seen a few of those. And according to our calculation, we estimate that sustainable funds, so these repurposed and rebranded funds represent now 20% of the European sustainable fund universe. And most of those transformations really occurred in the past 3 years. Next slide. So here are just recent examples of funds that rebranded. So they added terms like sustainable, ESG, SRI to their names to reflect the change of mandate and increase the visibility among investors who are looking to invest more sustainably. One now would be forgiven for assuming that maybe those repurposed funds are simply greenwashed or they haven't been completely revamped. When you look at the portfolio, maybe they haven't changed many holdings. It's true that some funds haven't made many changes. This is maybe because they were already quite sustainable before. They decided, because this is what investors want, let's make ourselves more visible, and just change name and just a few holdings here and there. But many others have undergone a total overhaul, and some even change portfolio managers. To assess the sustainability profile of repurposed funds, we looked at the Morningstar Global Rating, because we were just curious to know if really, although if it's difficult to see if there was really a change in sustainability profile, what we could do is look at what today those funds look like in terms of the Global Rating. And we found that the majority of rebranded funds, so 71% of them, now carry either a 4 or a 5 Global Rating. And that's compared to just 32% for the overall universe. So I think these figures should help to alleviate greenwashing concerns. Now, to finish on those repurposed funds, I also want to say that you can be cynical about it and say, these are just marketing decisions. I mean, some of them are marketing decisions, but I do think I think it's I see it as a positive trend, actually. Because we're not necessarily in favor of product proliferation. Product proliferation is not good for anyone. It's not good for investors. It's not good for asset managers. So if asset managers are able to, are looking at the fund range today and try to identify maybe funds that would meet investors' needs, and then make this switch, I think it is really not a bad idea. Next slide. So now looking at asset classes, what's available today for investors, that's looking at Europe. So in contrast to a decade ago, investors now have a reasonable number of choices when constructing comprehensive portfolios. There's still, there's still a lack of suitable product in certain segment of the market. For example, fixed income. We know the challenges of incorporating ESG in fixed income, especially in sovereign debt. But when you look at the equity side, I mean, there are plenty of options that investors can choose from. And in Q2, I think what we saw in terms of when you look at the products that were launched, obviously equity remained the asset class where you see the most launches and the biggest innovation. But we also saw many more multi-asset funds, so allocation funds. And so that's interesting. That's asset managers who are really keen to propose more like comprehensive, more consistent portfolio approaches. Next slide. Now I'd like to talk about the challenges that everyone, including us as a data provider, faces when it comes to identifying sustainable funds. That's, as we know, that's a major challenge for investors, and especially with fears of greenwashing. But like, how do you identify sustainable funds? So here I'm more at a very high level. The question we continuously ask ourselves at Morningstar when we classify funds is, where do you draw the line between sustainable funds and conventional funds? Drawing the line is no easy task, to say the least. It's not easy for two main reasons. First, because conventional funds are themselves becoming more sustainable. Today, more asset managers integrate ESG into their standard investment process. They do that to mitigate risk and enhance long-term returns. They also engage more with portfolio companies to improve business practices. And at the same time, asset managers are also screening out more controversial sectors and activities from their traditional funds investment universe. So, for example, tobacco, we've seen that like in continental Europe in the last 12 to 18 months, tobacco and thermal coal are two exclusions that we've seen applied now to many fund ranges, so across the board, not only applied to sustainable strategies, and also across asset classes. The other reason why it's not easy to identify those sustainable funds, to draw the line between sustainable and traditional funds, is that the information provided in legal and marketing documentations about how funds use ESG is often incomplete and unclear. There is a lack of standardized language, which makes it difficult to understand the extent to which funds adopt ESG. And that certainly makes identifying and classifying strategies challenging. Now, at this point, I'd like to mention the CFA initiative to develop ESG disclosure standards for investment products. I think this is a great initiative. It will certainly help investors more easily understand the features offered by investment products and make comparisons among investment products easier. Now, these standards, as you may know, don't seek to define what constitutes a sustainable investment product. And investors, especially those less sophisticated ones, will still be looking for some sort of seal of approval. They still want to know which products are green. They don't want to do too much due diligence. So next slide. And I think this is where the EU regulator comes in with the green taxonomy and the regulation on sustainability-related disclosures. So as you may know, from March next year, fund houses will have to comply with the EU Sustainable Finance Disclosure Regulation, which requires fund firms with over 500 employees to disclose the adverse impacts of their investments on the environment and society. And from March, all products will have to consider sustainability risk in their investment process, and the entire EU product universe will be subdivided into three. So first, those products that do not have a particular ESG focus. Those so-called Article 8 products, so those that promote environmental or social characteristics. And those so-called Article 9 products, so those that have a sustainability objective. Now, we are consulting at Morningstar with the industry. We're talking to asset managers to kind of check, compare understanding of this new regulation and what will be expected, or what does an Article 8 product look like, or what does an Article 9 product look like. I must say at this point, everyone is a bit, doesn't have much of an idea. So we'll have to wait and see how the regulator will want asset managers to distinguish this product, or to categorize the fund that they offer. What I can say is that although a majority of asset managers are supportive of these ESG disclosures, the timeline is certainly a concern. The full rules won't be known before January, and they will only have 2 months to prepare and publish disclosures at both a company-wide level and for individual funds. And the other issue is a lack of available ESG data from investee companies. Not all metrics will be disclosed by companies, and so the information will look very, very patchy at the fund level. Obviously, at Morningstar, we're watching this situation very closely, and we'll see if there's any data we can start collecting to help investors in select the funds based on this new disclosure. I think that is it. I think that was my last my last slide.
Great, thank you. So we'll open up the Q&A. Firstly, are there any hands up? Or is there anything in the chat coming in? We'll start with one just to set the ball rolling. So I think, thank you very much for the presentation. It was very interesting. Slide 2, it struck me that ESG is largely at the moment a European investor theme, or it was dominated by Europeans. So outside of Europe, where's the interest increasing the most?
Yeah, it's certainly increasing in the US. We're seeing very similar interest in the US, but they start from a much lower level. Also, it's important to understand that there is a lot of in Europe. There is a lot of institutional money in these funds. This is something that is hard for us to put data on. So I would not be able to tell you how much of the assets that I've just presented is retail assets or like direct retail assets. Obviously, indirectly, we know there's retail asset, but it's institutional investors making the decisions for the end investor. In the US, it's more of a retail market. So the funds that attract flows, they mostly attract flows from retail investors, even if though there is still also some institutional money. We've seen some funds like overnight just grow by 500 million or 800 million. Obviously, that's not retail money, that's institutional money. But we see interest growing in the US and more money flowing into those funds, more fund launches as well there. In Asia, so the landscape that I presented, it might be a bit misleading when it comes to the interest you may see from Asian investors, because in locations like Singapore or Hong Kong, they also use UCITS funds. So the UCITS money will be represented in Europe, will be accounted for in Europe, not in Asia. But we're seeing fund launches over there. It's slow, but there's definitely interest. There's more interest in thematic funds, especially in China. China is the biggest market in Europe. And when I say ex-Japan, obviously Japan is the biggest market. But after Japan, it's China, and you see a lot of interest for thematic funds around electric vehicles, renewable energy, and this type of themes.
Great, thanks.
But I think maybe also in Asia, they're still very much at the integration, ESG integration, focus on ESG risk stage.
Yeah. But we'll keep an eye on those numbers because they have a low base to increase from, but we'll see how I expect a bigger percentage change, I think.
Yeah.
Soon.
I mean, and also just to finish on this, I mean, obviously the regulatory agenda in Europe is driving also a lot of this interest and money into those funds.
Great. We have a question in the chat, and that is there any difference in the growth between SRI passive funds versus active funds assets under management. I think you showed
Yeah, there
that
was
slide
a, if you show slide 3, if you show slide 3, I mean, the market share for passive ESG funds has certainly increased in the last 3 years. We've seen a lot of product development there because of better data, or thanks to better data. We've seen there's been I mean, more ESG benchmarks have been created. And so that has also allowed more products to be created and launched. So I can't remember exactly the market share now for passive, but it may be like around just under 20%, maybe 17%, something like that now. So yeah, big interest for passive, and we know obviously the advantage of investing in passive funds is the low cost, and those funds also do not deviate. A lot of them, or that's an advantage or disadvantage depending on who you speak to, but they may not deviate too much from the market. So it's not too big of an ask for certain managers. So certain investors, or it's not a big step for certain investors to move from a plain vanilla benchmark to an ESG benchmark if there are maybe slight, like very light exclusions, or they can see that they're not the biases are not very, very strong in terms of sector and geographical exposure.
Great. Yeah. I think we have, yes, I think
Yeah,
there's
it's Robert Klaas here.
Great.
I have a question. Did COVID actually generate any changes in the research, the way you do ESG research? Is there a general trend you see in changing, for example, to more artificial intelligence? And if yes, has this kind of changed during COVID?
So I mean, we do not at Morningstar. We do not do research at the corporate level. We do research at the fund level. So we have, we are a partner, Sustainalytics, that does research at the corporate level. So and they've always used technology. I mean, especially in the last 3 years, the use of technology, AI, and machine learning tools. I mean, it's only been increasing, right? In the way they do research. Now, at the fund level, we are not using AI yet. But this is something we're looking into, because there's especially now with we see going forward with the news disclosure at the fund level, there will be more data we have to collect, and artificial intelligence is something that we can definitely use to help us collect data. I don't know if that answered your question, but I can't answer at the corporate level, but the fund level we haven't increased the use of AI yet.
Yeah, thank you.
Any other hands up, or should we go to the chat? The question in the chat. Okay, then we'll go to the question in the chat. So, Lindsay is asking, regarding slide 5, do you have a feel for the quantum of portfolio turnover in responses to the changes in mandate to incorporate ESG factors? So yeah.
No, it varies. It really, really varies a lot from fund to fund, even within an asset management firm. As I said, we've spoken to firm that said, for this fund, we just added a slight, ESG overlay because the fund was already scoring very well. But for other funds, they've completely changed the strategies, the investment objective. They changed even the portfolio manager. For this type of portfolios, it was a total revamp of stocks, and for that, obviously, it takes a while to execute, right? They don't do that overnight. So that's why for us it's kind of difficult just looking at the data to kind of track the changes, the portfolio changes, the holding changes, because we don't, they may have even started before they announced it they made the announcements. So it's very hard for us to analyze what's really changed and how much that has changed. It's only it's very anecdotal just from talking to managers. We know how profound some of those changes can be, or how light some of those also can be.
Great. And Irma put her camera on. Does she? Is that because someone has their hands up, or is that a reminder for? No. And there's some other questions coming in. I think there was a slide on asset class split. You mentioned that equity is dominating because of challenges in other asset classes. But going forward, are there any expected changes that you think? Any triggers or?
I think an interesting asset class to watch it would be or is fixed income. I think especially in the wake of COVID and more talk about climate change, we are already seeing record numbers of like green bonds being issued this year. In the wake of COVID, we see more social bonds being issued, sustainability bonds. You hear now about ocean like blue bonds, and with the green recovery plan, we'll see more of those being issued in the next few years. So I think these products will have to find their ways in portfolios, right? So we'll see more of more innovation in the fixed income space. And I think that would be interesting to see. Multi-asset also, I mentioned multi-asset. We're seeing more and more fund launches there. Alternative is an interesting one as well. Like there's still, hedge fund, what's happening in the hedge fund industry. I mean, hedge funds are still lagging, but some are increasingly interested in what they're seeing in the market, and they want to exploit certain maybe inefficiencies, or for example, if I think of the carbon credit market, we know that there's more activity there for hedge funds. So yeah, it's also an interesting one.
Great. So I think we're coming close to the end. We've got 7 minutes, so there are some questions coming in more now, but I apologize if we can't get to your questions. I think thank you very much for the presentation, and also for the good Q&A. I think just to wrap up, I would like to ask both of our presenters. There's so much going on in the space. It's quite overwhelming. I think we all see it every week. Just be interested in your views on what are you looking most forward to in terms of ESG developments in the next year. You've mentioned that there's the stuff going on in EU taxonomy. There may be a trend in the market, or there may be something more specific for you. So I'd just be interested in both of your views. Maybe we could start with Nina.
Yeah, maybe I start. There are many things, but I look forward to companies paying more attention to sustainability in general, due to regulatory pressure on the one side, and due to just the urgency given environmental and societal needs, and more generally. This relates back then to like our own corporation, and how ESG is further integrated, and how it will be further integrated throughout the investment sphere, and all investment managers across asset classes. And so I just have a huge hope and desire to see a huge increase in the market, and with that a change in how corporations treat the environment and societies.
Great, very hopeful for that too. And Hortense.
Yeah, I think what I'd like to see, I mean, what it would be great to see is more harmonization on in terms of regulation that would help, with data disclosure. That would also help clarify what ESG is about, and how investors can think about ESG and impact. I would also like to see, the US being instead of going backwards, to move forward and be more in line with our mindset in Europe and what the regulators are trying to do here, which is really creating a better and more sustainable world for everyone, and making sure through disclosure requirement, through mostly disclosure requirements, but all these like incentives as well. Make everyone move along in the right direction, as opposed to just thinking backwards.
Yes, I think there's a few of us who probably hope that the developments in the US are more a temporary blip than a permanent change. Great. I think we're close to the end of the session. So I think I would just like the opportunity to thank our presenters today, Nina and Hortense. Some really good insights on what's happening in ESG at the moment, and there's a lot happening. So that's great. Also, I'd like to thank Irma Henlane of the CFA VBA for helping organize this webinar, and also other members of the committee, particularly Mike, Adri, and Berry. Thanks you all for your questions. It's been good to make it work. And we'll be looking forward to inviting you for more sessions on ESG topic over the next year. So I'd encourage you to keep an eye on the CFA VBA website for more interesting sessions like these. So I think that's all. I think